That is some good coffee. All right, welcome back everyone to another video, all stock trading. Remember to subscribe, leave a like, new video every day, 5 p.m. Eastern. Today, I want to talk about why the markets are having a correction and why all you see is red in that market. So, the main reason that the market faltered this week and especially today is because of mixed employment data leading to interest rates going up. So, if you don't know, the Federal Reserve controls the interest rates and essentially controls the economy for one, preventing inflation, for two, incentivizing economic growth, and three, keeping everything at a consumer price index that people can afford. So, if you don't know, after 2008, the Fed really lowered interest rates to all time lows. They've kept it really low. They are tired of keeping it low because the economy is growing at such a high clip. Last quarter, it grew at 4%. To put that into perspective, usual economic growth is 2 to 3%. That is good economic growth. 4% is out of this world. Only Trump, believe me, he's the best, can get 4% economic growth. Now, economic growth is great, but with economic growth comes two things: inflation and higher interest rates. So, when the Fed raises interest rates on the 10-year Treasury bill, the 2-year Treasury bill, and the 3-year Treasury bill, and the 3-month, there's plenty. When they raise interest rates, so essentially when you invest in a 10-year bond now, you're getting more money back than before. And what this does is it competes directly with stocks. So think of it as the bond market competes with the stock market, and the stronger one gets, the weaker the other one gets. So if the bond market is strong, that means people aren't going to go to those value stocks that yield a high dividend, because the guaranteed money that is investing in the US and borrowing and lending them money has to be compared to the stocks. And right now, you can get a lot of money. So the Dow Jones fell 263 points just today, and essentially Intel led that with it lagging, and it's been on a run, so I expected a pullback. The S&P has also been in bear market territory. Well, not really. It's just going down 0.8%, and that is due to a lot of tech lag. So tech has been a huge growth factor, right? FANG, Facebook, Amazon, Apple, Netflix, Google have led to huge growth. They're all performing at record numbers, but number one, with higher interest rates, their jobs and everything get more expensive because there's less employment to go around. And two, all of the tech companies are being called on by the US government to prove that they're not corrupt and that they have values. Facebook, number one victim. Google, number two victim. Twitter, number three victim. And all of them together are trying to come up with an idea along with 80-year-old senators that, quote, "How does Facebook make money if they don't sell you products?" Mark Zuckerberg, the robot, responds, "We use ads, sir." Okay, great. How is he going to come up with regulation? Who knows? The Nasdaq fell 1.5% due to a pullback in FANG. Of course, the Nasdaq led mainly by tech. The real reason is that job growth missed, but unemployment is at an all-time low. So when you have job growth that's missing, one, because the economy is such a strong point right now that actually there's more jobs out there than people looking for jobs, right? So clearly unemployment is at an all-time low right now, which means that job growth is gonna slow down. Because if everyone has a job, then there's not too many more jobs to create. Also, wages are up 2.8%. Wages and inflation are like two beans in a pod. When one goes up, the other goes up, right? And that's because the labor market is really tight. So what happens when you have more jobs than people looking for jobs? Suddenly, people have a choice, right? People haven't had a choice as far as where they want to or are going to work since 2008. And now that companies have to compete for workers, suddenly wages have to go up. And they went up by 2.8%. It makes sense economically. Also, upward pressure on rates is completely terrible for stocks. So anytime that the bond market goes up, inflation also goes up. So it means two things. One, that the most competitive investment alongside stocks, which is the bond market, is suddenly a lot more interesting to a lot more people. And number two, it means that interest rates are going to go higher and that inflation is also going to go higher, which means less economic growth, which means less lending by the banks, which means harder to get money to invest or start your own business. It's part of the economy. They have to do it. The Fed has been telling us that they're going to raise rates. They haven't since 2008. Deal with it. Also, the 10-year and 2-year at an all-time high, right? The bond rates. But also, the volatility index, the VIX, is at an all-time high since 2011. So there's a lot of volatility in the market. If you think about it, with Trump and China, with all these tariffs going on, right, $200 billion worth of tariffs, and then you have interest rates going up, and then, so here's the thing, I'm going to explain to you why economic growth and wage increases, though they might sound like a good thing for the economy, a lot of investors believe that it's actually the bad thing for the economy. The reason they believe that economic growth is a bad thing is because it means that we're over accelerating. So essentially, we're about to hit the peak of the bull market, right? All-time unemployment, wage growth, and essentially companies are going to cut back, right? Suddenly, inflation is going to go higher, interest rates are going to go higher, it's going to be harder to get a loan, and we're going to have economic slowdown. However, if Mr. Powell, which is the chairman of the Federal Reserve, is correct, as he should be, then the interest rates going up should counteract inflation and should counteract the economic growth, but not to the point where we start slowing down to economy and it becomes detrimental to companies and leads to a stock market collapse. In my opinion, that is not going to happen. People need to deal with interest rates. People need to deal with the fact that if you want economic growth and you want almost every company in the stock market, every company in the stock market is doing a huge buyback of stock. Companies only buy back their own stock if they believe it's undervalued and if they believe it's a good investment because in the long term, it will be a great return. And I think that's what you should do as well. I think as more volatility comes into this market, which, by the way, almost every company reported record Q2 growth. Apple, for example, reported record Q2 growth. If you want to know more about why they are not just an iPhone company anymore, go back to the Apple video and watch it. Also, with trade deficit up 53 billion and now at 8.6% higher, there's so much volatility as far as uncertainty that if you're in the market right now, don't sell, right? Unless we have a huge correction out of nowhere, then don't sell. Even if we do, look, I'm going to leave you with one quote. Warren Buffett says that when there's blood in the streets, like right now, he's greedy. And when everything is high and people are making money, then he's fearful. I want you to be greedy and start investing in stocks when you see them at a discount. Have a great day, and remember, new video every day, 5 p.m. Eastern. Subscribe, leave a like, and comment down below. Is the economy coming to an end, or is this just the beginning of another cycle? See you later.